The Money Café is proudly brought to you by Intelligent Investor, Australia's home of value investing. For a limited time, you can get Alan Kohler's weekend brief, in-depth economic analysis, CEO interviews, the latest market insights, a limited edition Money Café cap and more for just $297. Find out more at moneycafe.com.au.
Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist. And we are the Money Café. Well, Alan, how are you holding up with, we'll get to the budgeting questions, I guess, but still a fair bit geopolitically. Trump to China, the Strait, will it ever open? What's your latest hot take on all the geopolitical issues?
I think Trump went to China hoping that they would pressure Iran into opening up the Strait of Hormuz. And, who knows whether Xi Jinping tried to do that, but it certainly didn't work if he did. And so Iran, some ships are getting through. It's unclear whether they're paying Iran's toll or not. I think some of the kind of talk seems to be that they are. Some of them are paying the toll, some are not. China is getting most of its ships through the Strait. So that's probably why Xi Jinping wasn't too keen on, didn't care much about, forcing Iran to open it up fully. So look, I think the main consequence of the kind of attack on Iran that Israel and the US mounted in the end of February is that Iran's now got control of the Strait of Hormuz that they didn't have before, and that's kind of where we stand. So Trump has said last night, he told reporters that we might have to give them another big hit in order to make them see sense. We'll see if that would work because it didn't work last time. Don't forget this is a regime that didn't think twice about killing thousands of their own citizens when they protested earlier in the year, and I don't think they'll care too much about whether people get killed by American bombs.
It's looking like a quagmire, isn't it? Like just a standoff. Trump started two wars, a tariff war and an Iran war, and he's backed off on one and stuck in a quagmire on the other. There's a risk he goes the way of Jimmy Carter, with this being his, the thing that people remember him most for. Because people are saying that the oil reserves are falling.
Yes.
The futures in December, the Brent crude futures in December have leapt from $70 to $90. So reserves are falling. June, July, if the Strait remains, predominantly closed, then you will see a lot more grief, demand destruction, jet fuel, fertilizer. Like the impacts are going to get significantly greater if the quagmire remains in place.
That's right. Leaving aside sort of all the fertilizer and all the other stuff, where we seem to have settled into a deficit of 6 million barrels a day, according to the International Energy Agency, and that gap, that deficit is being made up out of inventories, and naturally, of course, they're starting to run low, and they'll at some point run out. So they can't keep going on. It's got to stop.
And Trump took the heaviest hitting business delegation ever assembled to China, and they didn't actually seem to have a whole lot to do over there. The number one Chinese message was Taiwan, and nothing was done on chips. So Jensen Huang's there, and Trump hasn't opened up the chips. I thought your comment on insiders was interesting about chips and planes are the two industries that the Chinese don't dominate. So they announced a 200 planes Boeing deal, but there was no sort of chip deal, and there was a distinct lack of news that came from assembling the greatest ever business delegation put together. Tim Cook, Musk, Jensen Huang, a whole bunch of others, and they would have got back to their boardrooms and said, well, that was a bit of a waste of time. On
a slightly other matter, did you see that Trump released his first quarter share trading disclosures?
He trades as busily as he posts on Truth Social, isn't it? Apart from trading and posting on Truth Social, what else does he do in his day apart from playing golf?
Well, there were 3,700 share trades in the quarter, which kind of averages out about 100 trades a day. I mean, it's unbelievable what he's doing. And there was somebody posted on X last night showing that they've gone through the trades and found that most of them, or at least a lot of them, were done before he announced something concerning that company. So he was actually, it's basically insider trading most of the time.
Yeah.
He's just he buys shares in the stock, in the company, and then in one case he visited the factory and talked about how terrific the company is, having bought the stock. He's the Justice Department or some other part of the government is negotiating a deal with the company. He buys the stock and they then announce the deal or announce the new regulation. I mean, it's unbelievable what he's doing.
Well, him and his billionaire mates, they're clearly monetising the office, and that's his biggest concern is his family, his billionaire mates, and monetising the office. So I think he'll go down as the most corrupt president in US history. Nothing's stopping him now.
We've got a lot of questions about the budget, so we probably need to get onto it. But have you stood for any boards lately?
Oh, look, I've actually got I've got 8 tilts in the next 9 days coming up. Mainly to do with retail shareholders being ripped off with placements. There's been no share purchase plan, but I was and also dinosaur physical meetings in Perth. But you'll be amused by this one, Alan. I've managed to unite the Chinese Communist Party and the Murdochs over the last week because they've both voted against me. So at Grange Resources, it's owned 48% owned by a Chinese state-owned entity called Shagong. And I got more than 99% of the votes against me. So the CCP weren't impressed with my nomination and voted against. And then yesterday at the Brisbane Broncos, the Murdochs, who own 68.9%, have voted against. And I got my worst ever vote. I got 99.8% against. But I've just gone and looked at the numbers. If you strip out all the votes that the Murdochs controlled, I actually got 21.4% of the vote. I had 136,000 in favour and 500,000 against. So nobody else bothered to vote. It was just Rupert's 68.9%. I picked the wrong year to run for the Broncos, Alan. They won both the men's and the women's premierships. So
they've decided that they don't need Stephen Mayne.
Correct.
Clearly.
Well, the Murdochs are never going to vote for it. But the Murdochs are now $100 million in front on their Broncos investment. So I reckon they should cash out. But I couldn't go. Actually, I've done my back, so I didn't even turn up at them. I couldn't fly to Brisbane or turn up. So I've no idea what actually happened. Yeah, I'm waiting for a cortisone injection. Actually, I've been in bed the last 3 days. Every 2 years, I have to get a cortisone injection because my discs are too close together. The nerves have all gone, and I get totally crippled. And then I get this magical cortisone injection, and it keeps me walking again for 2 years, and then all of a sudden I wake up one day and I'm crippled and can't walk. So every 2 years. So it happened on Monday, so I've been bedridden all week, and I'm crouched over my desk here talking to you, trying to stave off the pain, waiting for the steroid injection later today. But look,
I hope you get better soon, Stephen.
Fit man, and you're into your 70s, and you're fitter and healthier than me, it seems. Now you've been everywhere, Alan. You were on the Insider's couch. I've listened to you on Michelle Grattan's podcast. The budget, and we'll get to this with questions, but what was your Insiders experience like? So they didn't fly you up to the budget, but they flew you up for Insiders the following Sunday, and you caused a storm on Twitter with your incisive, cut-through budget commentary. What was the experience like at your end, and what was the reaction like?
The experience was good. I mean, I like David Spears. I like Phil Curry. I like Samantha Maiden. It was a good experience. It was my first time on the Insider's couch. I mean, look, it's a bit of a pain in the neck going to Canberra for it, so I'm not going to rush back in a hurry. But it was nice to do it.
Well, everyone said you did very well. You were straight talk Kohler, telling it like it was. I did love your summary of the bracket creep. Is that Fraser brought it in. No one thanked him for it. It was a hidden tax cut, and so he got rid of it, and now Angus has gone for it. So
that's what I said. When you're a politician, what you don't want is hidden tax cuts. You want hidden tax hikes.
Exactly. Now we've got every possible angle in question, so this is more important than ever, I think, this week that you need to do our disclaimer.
Before we get to the questions, we have to have a little word from our sponsor. So here's that.
If you're listening to the Money Cafe, you're probably the kind of person who doesn't want to be caught out by the next big shift. Whether it's AI, a policy change that hits your hip pocket, or a market move that catches most people off guard. Right now, Money Cafe listeners can get a special deal on Intelligent Investor Essentials. For just $297, you'll get Alan Kohler's Weekend Brief, the latest market and economic updates, and subscriber-only podcasts, including CEO interviews and Talking Finance, with in-depth interviews on business, the economy, and investing. And when you sign up, you'll also get a limited edition Money Cafe cap plus 3 months of Intelligent Investor Premium. That's $726 of value for just $297. Go to moneycafe.com.au to claim it before it ends. T's and C's apply.
Now, just to remind people, we give general advice only. We can't do personal advice and, don't know anything about you. So that's the general advice warning. And so off you go. Stephen, you're going to read the first one.
Ian says, not so much a question as a comment to say a big congratulations and thank you following the budget night announcement that this is the end of the negative gearing and capital gains discount cocktail for investors in housing. When I read your quarterly essay calling for these changes, I never thought I'd see it happen, and yet here we are a few short years later, thanks in no small part to your persistence and work in explaining it in simple terms to everyday Australians, which has helped pave the way for this to become politically possible. I hope you enjoy this moment, Alan, and a well-deserved celebratory drink. Now, Alan, unfortunately, the budget is a whole lot more than just what you were calling for, so I'm sure you're going to distance yourself from every other attack on trusts and shares, but in terms of the housing one, you must feel like it is a bit of a win.
Oh yeah, sure, it is definitely a win. This might short circuit some of the questions, but I find it very interesting. Everyone's carrying on about it. How the going to pay more capital gains tax on housing. I mean, I thought we had a consensus in Australia that housing was unaffordable and we have a crisis and we need to make housing more affordable, which means it doesn't mean anything else but not having capital gains on housing. So there shouldn't be any tax to pay because there shouldn't be any capital gains on housing anymore because we need to make it more affordable, and everyone agrees on that. Now, so, I just think, maybe it won't work because, they're not building enough houses or, basically the government policies to make housing more affordable won't work. Okay. Maybe that's true. But I think, if you do bet on getting a taxable capital gain from housing, what you're doing is you're betting against the government. You're betting that the government won't succeed. Well, fair enough. Go for it. But I reckon that's not a bet I want to make.
Well, the government's saying 2% less annual rise in house prices as a result of its policy suite on budget night. So it will be very interesting to see, we've had obviously the first weekend of auctions looking a little bit tepid, but it is a bit early. It will be interesting to see if it does create a fear of suboptimal returns in housing going forward. But what the policy changes don't do is force people to sell. And so this has always been the experience in Australia, is that we've never had a reduction in house prices of more than 10%. And whenever prices fall a tiny bit, volumes fall because people go, well, I'm not going to sell into this market. So I sort of thought the capital gains, so the negative gearing component of the budget was the most tepid in a sense, in that they've grandfathered everything and the music still plays on new builds. So if you got an apartment off the plan buyer, and my first home was an apartment off the plan, you're competing with those very same tax-driven investors, albeit in an environment where people are a bit concerned that the market's overheated and toppy and might not go up very much. But I was surprised that they just did so much else in the budget. And the actual negative gearing on housing component, because of the grandfathering and the continuation, it actually wasn't that comprehensive. And I don't think it will have that big an impact on, 2% a year by definition is not a big impact.
No, it's not. And what it would do if 2% a year happens, that would bring the average rise in house prices back to the rise in incomes, in wages, which means that house prices would continue to rise at the same pace as wages, which, maybe you could say that's okay, but basically that means that the current house price to income ratio would continue on. So that means that if we've got a crisis now in terms of affordability, which is expressed in the house price to income ratio, then that's where we're going to stay.
If you're starting with nothing, Jim Chalmers did say, house prices have gone up 400% since 1999, which was your big line in the essay. And frankly, if you're starting with nothing now, it's even harder to get into housing, as we'll get to with future questions about increased taxes on every other savings vehicle out there. So anyway, your turn.
Okay. Julie says, okay, I understand the budget's reasoning with the treatment of investors that invest in new homes versus the treatment of investors that purchase existing homes. Lowering the incentive for investors to purchase from the limited supply of existing homes gives the first home buyer a bit more leverage to compete in the used housing market. And providing incentives for investors to build homes in increased supply. All good. What I don't understand is the CGT changes on shares. And I think Michael has a similar question. He's got a son saving his money and putting it into the stock market, hoping one day that they can break into the property market. His reaction was that he'll now just get slugged with more tax on his shares. So look, I mean, they've decided to make the changes apply to all assets. What Jim Chalmers has said about that is he's argued that the capital gains tax discount and negative gearing are long-standing system-wide tax settings that apply to all assets. So any reform should apply broadly to all assets as well, and that sort of thing. But he hasn't really given a detailed asset-by-asset justification. He hasn't said, well, this is, he said why we need to do it for property, which is fair enough, but he hasn't said we need to do this for shares. And I don't think he can. I mean, I don't think there is a reason to do it for shares. So I suspect that they'll probably take it off if they can. I don't know if they can actually take it off shares. I certainly think that they will if they can.
I think they'll give ground in two areas. I mean, the reaction to the budget's been enormously negative. I mean, not just the integrity broken promise thing, but the fact that there's masses of losers and very few winners. So it's a very unusual budget. But the idea that you get the minimum tax of capital gains tax, 30%, even if you haven't used your tax-free threshold. So you're a young person trying to save up, you've had a little win on the share market, bang, flat 30% on your shares. That's brutal. I don't think that'll survive. And then you've had all the memes on the 47% startup business stuff, and we'll get to that in later questions, but that's going to be unsustainable. World's highest capital gains tax rate on startup businesses. And the memes of welcome Albo, 47% shareholder in our business. That's toxic politically. He's being mocked and laughed at. So I think that's going to be tough. But look, we'll keep going. So Mark says, as a deflated 36-year-old with $1 million mortgage on a $1.5 million house, I wonder what's next. Clearly, tax incentives and supply have helped property consumers drive wealth in Australia. It looks like the gravy train will finish. And instead, housing may see 2 to 5% raises each year, while other industries like shares or tech return over 10%. So Mark goes on to say that he feels deflated because he's worried that he's overpaid for his house and that asset is not going to perform and he's going to be under the pump. So I guess this is the political tightrope that's being walked here, is that because we are the world's most indebted households with massive leverage on property, anyone who's entered the market in the last 2 to 3 years, so the later you've entered, the worse it is for you. And anyone who's got leverage, and Mark's got $1 million mortgage on a $1.5 million house, so he's 2/3 leveraged, very exposed to a 10, 15% drop in housing, or just it going nowhere because you've got to come up with servicing $1 million mortgage every year, and that's not even tax deductible. You've got to service that mortgage with after-tax dollars. So there's a large cohort of heavily indebted mortgagees out there, whether it's negative gearing or owner-occupied, who are going to be very nervous about a property market correction. And this is the tightrope that the government's got to walk, isn't it?
Yeah. Well, we've had 25 years of housing prices rising at double the rate of incomes, and that can't go on. So at the very least, the rate of increase in house prices has to has to come back.
But we can't afford a Canadian-style 20% reduction in house prices. So the government will manage things like, and the Reserve Bank will be conscious of it with interest rate settings. The government will be conscious of it with migration settings. So you're right. We're not going. I don't think we're going to see a reduction, because the moment you did see a reduction, all the political, the anger of the Marks of the world, who are suddenly really screaming in more pain, will kick in. So it's a very delicate balancing act to get. All right, Alan, you may as well do Tara, I think.
As a woman in my 40s, I can't help feeling defeated with this new budget, mainly the new minimum 30% tax rate on capital gains sales on shares. I work in graphic design, so I can see the writing on the wall with AI overtaking my industry in the coming decade. I've been working so hard to put away the majority of my income into shares to live off a supplemented income for when my industry inevitably collapses. If I'm no longer able to access a tax-free threshold when I start selling down my shares, how on earth am I meant to support myself without paying an exorbitant amount of tax? Do I retrain now in my 40s into another industry and start again from the bottom? Yeah, well, I think that's right. I mean, that's the 30%, actually the minimum 30% tax rate on capital gains and on trusts, for that matter, was a surprise in the budget. I don't think that was expected. The shifting of capital gains tax discount from 50% to the inflation adjustment was kind of leaked, but they didn't talk about there being a 30% minimum, and I think that's kind of caught everyone a bit by surprise. And what it means is that if you sell an asset and your tax rate is below your marginal tax rate is below 30%, you're going to have to pay 30%.
So they've created two classes of income. There's the salary class, and then there's the capital gains tax class. And so you can't use your 18,000 tax-free threshold on capital gains anymore. You go straight to 30%. Now that seems, I know the Labor government's always going to favour Labor. I mean, it's the old Labor versus capital. John Howard went too far with work choices, and I think this is going to be Labor's work choices moment. They've suddenly got control of the Senate with the Greens. They're the Labor Party, and they've done a big hit on capital. And they've gone so far, they've even hit a punitive 30% capital gains tax on someone with no other income. You can be as poor as you like, you have no other income, and you're paying a flat 30% capital gains tax. I mean, that is going to be politically unsustainable, because a lot of young people are into shares. I mean, my kids, can't afford a house, still living at home, building up their shares. And so it's hitting. I just think this policy is not going to be sustainable, and they'll have to just go back to capital and labour being not distinguished between, and you are taxed on your marginal income tax rate regardless of what sort of income it is. I mean, no one saw it coming. I mean, normally at council, you put out a draft budget and you call for consultation. I mean, this should have been a public submissions process for a review of the tax system. To bury all this in the budget out of nowhere, no warning it was coming, was remarkable. I just can't believe that Albo's overreached like this. I mean, the hubris. Every tax grab from the bottom drawer he's ever had seems to have come in here. I mean, we'll get to trust, but I just find this flat 30% unbelievable. And I can understand why Tara's feeling upset about that. A lot of people are upset.
Yeah.
Now, Simon says, given Alan has highlighted the productivity growth in Australia, do you think higher taxes on startups and high growth companies will make this issue worse? Well, that's a bit of an obvious statement. But, where are you on the startups one, Alan? I mean, they've promised consultation and positive, possible measures to deal with the 47% tax on your startup, which is flipped after 2 or 3 years. Where do you think they'll go with it? And why do you think they did it as brutally as this? I mean, why no carve-out for startups? Startups was the reason that Howard did this in the first place, because people were paying such huge tax bills during the tech boom.
I do think they'll have to do something about startups. I mean, I sold a startup, and the
so did I. We both did.
And the cost base is zero, and so therefore you got to pay on the you don't pay tax on the capital gain. You pay tax on the whole the sales price. You pay the tax on the whole amount. I mean, it's a bit of a whack. I mean, it's seriously, and I suppose it really makes a difference. The 30% minimum makes a difference too. So yeah, look, I think that is an issue for sure.
Because if you look at other countries, so Singapore and New Zealand don't have any capital gains tax. In America, it's I think 23%, but the first 10 million gain is free. So they won't go to zero, but they'll have to. I mean, at the moment, I think there's exemptions for businesses with revenues of less than 2 million. So it's not just punitively on everything. There are a number of carve-outs, but I think they'll have to do something about, the first proportion is tax-free or something like that, or to cap it at 30% or something. But just, yeah, it's particularly, I mean, the reason it's different with startups is with housing, you always have a capital cost you've put in. So you buy the house for $1 million, sell it for $1.5 million. But with startups, there was an architectural firm letter to the paper at the Fin Review this week. What are the costs of building an architectural practice? Not much. Computers, and so when you sell it, it's all capital gain. It's all profit. But you might have worked for nothing, mortgaged your house, taken a risk. And this is the thing. If you go bankrupt doing a startup, Albo's not going to come in and pick up the pieces for you, is he? He's not going to come in and say, well, you took a punt. But if you go well, and 47% top marginal tax rate. So this is the inequity of it, is it's not paying attention to the genuine risks and sacrifices that founders will do. And I think it will drive down entrepreneurialism, or Australian-based entrepreneurialism, although there was that famous quote from Warren Buffett which said he's never known anyone to not make an investment because they're worried about the tax they're going to pay at the end. But there's been so much publicity about this 47%. I think that if you were starting out now, you would say, what about Singapore? What about New Zealand? Because capital is mobile. And, so I agree they're going to have to go somewhere with this and make big changes on that front.
Well, while we're on that sort of thing, we've got a couple of questions later on about trusts and the new 30% minimum tax on trusts. I just think it's worth. So Mick says family trusts are an important tool for asset protection. Do you think Jim even considered this when he took a hatchet to a centuries-old structure? What other options do we have now to protect the family's wealth? Could you protect? And Philip says, could you explain how the tax on trusts helps intergenerational equity? The new tax replaces marginal tax rates on trust distributions with a 30% flat rate. This means that an individual paying tax on a distribution from a trust is paying the equivalent tax on a $250,000 salary of someone on a marginal tax rate. How is this fair? So, I mean, there is an issue here with income splitting, which is what taxes are, the trusts are mainly used for, so that people who are partners in big accounting firms or law firms or just in business, they get income into the trust and they distribute it to their spouse and children who are on lower marginal tax rates. And so the ATO has been trying to crack down on this for years by saying, the recipient of the distribution has to basically has to be part of the business. They have to be earning some of the income, right? And so they've been trying to deal with that, but they haven't been able to. I mean, it's just too hard. They can't really prove whether anyone's, participating, earning the income or not. So they've basically, what this means, what this new 30% minimum means, is that they've given up. The ATO has given up trying to ensure that the recipients of distributions in trusts actually help earn the income, and they're just saying, okay, we're just going to give up on that. We're going to make it a flat 30%.
Flat 30%, which is a very brutal move. I mean, the data shows, I think, that there's 840,000 trusts out there in Australia, and overall, the people using the trust structures are paying 4 percentage points less in tax overall. So it is a bit of a tax shelter, but I think they've been really brutal coming out with this 30% flat rate. And then you've got we should probably briefly touch on the death tax claim, the testamentary discretionary trust. There's 10,500 testamentary discretionary trusts out there at the moment, they're grandfathered, they're fine. But if you, after July 1, 2028, if you set up another one of those to do with your estate, a discretionary trust where the person who's passed away gives discretion to the people who are the trustees, they'll be taxed at the 30% rate. So obviously no one will use this structure going forward. You can still go with a fixed trust where the person who's passed just specifically prescribes who's getting what. I don't know why they've made a distinction between discretionary versus fixed, but so there's no death tax in Australia, there's no death duties, and this structure will not be used when it no longer is tax sheltered for wills and estates. But overall, we're going to need to have mass graves, mass funerals for the trusts of Australia. Like they've just made trusts very, very unattractive, and their goal seems to be super, super, super. Like the most tax-preferred place to do anything is super. So a lot of the advice you hear now is just put all your money into your family home because the family home is still tax protected. Use your grandfathering where you've got it with investments, and then $2 million into your super, husband and wife, before you hit the punitive tax levels in super. So keep it simple. Use super, because even on capital gains tax, the tax rate within super funds is only 10%. Because you get a 33% discount. So it's 15% tax within super. And then if it's a capital gain, you get a 33% discount on that. So it's down to 10%. So it's Labor. They created super and they're shutting down all other options outside of super. And they're saying, everyone, we want you to use super. So super will get turbocharged as a result of this. And there'll be mass burials of trusts because they've really gone for it. It's raising more than $40 billion over 10 years. Okay, PC says, Alan, the government is projected to strip $77 billion from property and trust structures over the next decade, yet Treasury's own modelling admits this will yield a net gain of just 30,000 new homes. Nowhere near the 100,000 promised at last election. If they are raking in a $77 billion war chest while barely moving the needle on actual supply, isn't this simply a massive revenue grab disguised as a policy to help the next generation? Well, Alan, let's get on with this the supply question. It won't help supply, will it? In fact, and it will put up rents as well, won't it?
Treasury's modelling says that the capital gains tax and negative gearing changes will lead to 35,000 fewer homes over the next 10 years, and they've offset that with this $2.1 billion infrastructure fund, which they say will lead to 65,000 extra homes. So it's a net gain of 30,000, but only because of the $2.1 billion they're proposing to spend on infrastructure. So the taxation changes on their own, according to the Treasury's modelling, lead to 35,000 fewer homes. So, yeah, I mean, it's worth kind of airing the forecast of the National Housing Supply and Affordability Council, whose chair, Susan Lloyd-Hurwitz, I interviewed on Monday, because they were set up with the Housing Accord. Their job is to monitor how it's going, demand and supply, and they've forecast the supply of housing over the next 5 years during the Accord period to 2029, and their forecast. Just to remind you that the Housing Accord target is 1.2 million homes over 5 years from the middle of 2024. The council's forecast is for 980,000 homes, so less than the 1.2 million, and they forecast demand over the same 5 years to be 900,000. But the thing is that those 1.2 and 980,000 numbers are gross. They don't include demolitions. And the council has forecast net housing, extra housing over the 5 years, including demolitions, of 862,000. So that is not only a lot less than the 1.2 million target, but it's less than demand. And now there's going to be fewer as a result of this modelling, and they reckon there'll be an increase of 65,000 as a result of the infrastructure. So, and all this basically, don't forget, is Treasury modelling. And modelling is kind of, well, I don't know. I mean, it's just another way of guessing. You're just, putting some stuff into spreadsheets and hoping it's right. So, modelling doesn't mean houses actually appear. Let's face it.
Yeah, that's true. But the approvals for the last 3 months have actually been ticking up. And the migration numbers are coming down, although not as fast as the government had previously forecast. So there is a little bit of a coming together of there is a bit more supply coming on and migration is coming down. But what do you think of Angus Taylor's linking of migration to actual houses built? It seems that's, I thought Abel Rizvi's comment that you might do that as a long-term target, but it's not practical to do it year by year, although obviously he's trying to fend off one nation and it's a populist move. But what did you make of Angus Taylor's migration policy and also the bracket creep thing? I mean, the bracket creep thing is massively expensive, but it will be very, very popular. I mean, I thought it was a very potent line when the government came out and said you've got a $250 billion black hole with that policy, and he's gone, well, that's what you're admitting is your tax grab for the next 10 years. So now you're admitting how much you're grabbing off Australians, and we still are paying far more income tax than most other comparable countries, and that was the missing thing from this budget. It was a grab of capital without any handback to overtaxed wage earners. So I think Angus Taylor will be on a winner with promising real worker tax cuts, which is the missing piece which will presumably come before the election from Labor.
Well, we'll get on to that in a moment. Just on the linking of housing, linking of immigration to housing, that's what I proposed in my book on housing, that be done. I didn't actually think they should or probably could, actually physically limit it. What I suggested is that every quarter or something that the housing minister and the immigration minister both put out a press release saying that this is what's been going on. This is the number of houses built. This is the number of migrants that have come in, so that everyone can see what the difference is. And then maybe over time, as a result of that kind of airing of the two numbers, they'd actually understand that they need to be the same. So, but whether you can, I mean, I think Bill Rizvi's pretty right. I mean, I think it'd be hard to say, if not impossible, to say, well, we've built this many houses in the last 12 months, so we're only going to let this many people in. The trouble is, I mean, part of the problem is that the number of people per house is kind of hard to nail down. I mean, the total gross ratio of people per house at the moment is 2.4, or is it 2.5? It's something like that. But the people coming in, there's probably more of them per house, or is there less? I mean, and young people tend to be 2 per house, not 2.5. And there hasn't been any discussion by Angus Taylor of how he's going to talk about how he's going to deal with the ratio, the number of people per house as part of this policy. So on the other thing about tax indexation, I just think it's an economic winner. I mean, it's the right thing to do economically, but politically, I just think Malcolm Fraser campaigned on it in 1975 and then did it in 1976 because he'd promised to. But it was politically terrible, and he gave it away after 6 years.
Yeah, I just think that I think Fraser's had a good, Angus Taylor's had a good week, and the economy and taxes is his strong suit. And I do think that Albo and Chalmers are in trouble. I mean, there's no record. Every time you've had a massive broken promise, whether it's Keating's LAW law tax cuts, Gillard's no carbon tax, Howard work choices, the Australian public, they really don't like this, and this is the worst budget since 2014 politically. I mean, I think you've seen how quickly it fell apart for Starmer in the UK. I mean, he's done nothing wrong, Starmer, and he's got Farage, so we've already got One Nation on the rise. I'm just amazed that they've just gone so hard with such a toxic budget, and all of a sudden Angus Taylor's, they looked like they were in chaos, and then he's actually sounding quite sensible, and everyone's going, yeah, that makes more sense. So anyway, look, Mason says, I thought it was interesting to note that it wasn't in last week's budget. Do we expect that the Labor government is saving up potential changes to bracket creep or resources tax to be released in the lead up to the next election? So I think that, the tax, the gas tax thing probably does come next year, because I heard Tony Barry saying this week that a lot of young people in focus groups are saying, well, why are they hitting us with the 30% capital gains tax on our shares? Where's the gas tax? So that narrative, that campaign the Australian Institute has run has been very effective, and I think that that tax will come. And so give us a final comment, Alan, from you on the 30% tax on shares. Are you upset by that? Do you think that's wrong? Do you think they'll move on that? Putting you on the spot here.
I do think they'll move. I think that the purpose of changing the capital gains tax back to inflation adjustment was to remove the mistake that was made. I mean, look, you can make an argument that the whole thing was a mistake in 1999 because it really did favour property. I mean, I read the report that came out in 1999 that led to the capital gains tax discount of 50%. And the guys doing it, who were John Ralph, Rick Allett, and Bob Joss, who were basically company directors. Bob Joss was the CEO of Westpac, or had been, and they said we should change it to a 50% discount to encourage investing in shares, and that was the whole point of the change. Actually, I mean, when Costello announced it, that was why he did it, to encourage investing in shares. And then there was a stock market crash and nobody wanted to invest in shares anymore, and so it was all put into property. And it probably was going to be anyway, because property benefits more from negative gearing and the capital gains tax discount, because you can borrow more against property. You can borrow 80% against property, but only 50% against shares. And anyway, nobody really borrows to buy shares. Not many people anyway.
No, that's right. And the other point is that with negative gearing, you can run the losses against your wage.
That's right.
Whereas you can't do that with shares. So that's the really special part about negative gearing is getting your tax bill down by reporting losses as you hold this thing. A lot of it's depreciation losses. I mean, I remember when I bought my apartment off the plan, there was this depreciation schedule, and every year I could just bung, $10,000 for the depreciation of my curtains, the carpet. It was this whole schedule in the developer document when they sold it.
Yeah.
And you can't do that with shares. So that's what made property so tax effective. And then throw on quadrupling of prices and then the CGT, and it just became a winner. And then more and more people just won with it. But you have to take away that ability to write down your tax on your income, because that's where it's preferred over shares and every other asset class. Bonds, you can't do it with bonds. It's only residential property. You can't even do it with commercial property. So they had to shut it down, but they've grandfathered it, so it's not going to have a big impact, because there's going to be millions of negatively geared properties that'll roll on for the next 30 years. It's a bit like the capital gains tax pre-1985. It's taken them 41 years to finally come in and say, Jerry Harvey, you might have a pre-1985 asset, but you got to value it June 30 next year, and then if it doubles from there, you're paying capital gains tax on it. There's no longer a total holiday on. That was one of the other things that I was amazed they reached in and grabbed. I think it's the right policy, and there's not many people with pre-1985 assets, but it just goes to show how sweeping the grab was, that it even pulled in something which for 41 years had been grandfathered. So will they get rid of grandfathering of the capital gain of the CGT negative gearing, just like they've killed the grandfathering on pre-1985 CGT?
Yeah, I don't know. I mean, I think there'll be some adjustments to this. I think that's true.
There'll be big adjustments, but they won't come from the Senate. I mean, Abbott's budget in 2014, all the adjustments came from the fact that the Senate was hostile. The Greens will wave through every one of these tax grabs, although they might make some noise if a few young people hit the Greens about the CGT on shares and not being able to use the tax-free threshold. The Greens might step up on that. if they get pressure. So if you're a young Green voter, get onto your Green, because the total budget is totally in the hands of the Green senators. It's a Labor Green-controlled Senate. No one else can influence it. And the Greens would normally be supportive of every last attack on capital, attack on business. But if enough young people hit the Greens up and say, this is unfair, as I'm trying to save for a deposit, then I think even the Greens might say, give a bit of relief to young people. Now, Alan, before we go, we've had a couple of questions on CSL saying,
Yes.
The stock's crashed. Do you think it's going to recover? Pointing out that the multiple at the moment does look cheap, relatively cheap. The earnings of the business, the basic core, plasma business is still strong. Is it an overreaction? Like the stock's gone from a peak of 300 to 98. It's below 100. So what are your thoughts on CSL?
Look, obviously it's still a good business. The plasma business is fine. I mean, the trouble is that the market, investors have lost confidence in the company. I mean, and how do they get that back? Share prices are not just a matter of mathematics; they're a matter of confidence. And the reason that CSL shares went to $300 and a sort of PE ratio of 40, more than double the average market PE, was because everyone loved it and everyone thought it was going to keep growing at much more than every other company. So. And now the market doesn't think that anymore, and I actually think that they won't get that confidence back. It's impossible, really.
Well, the market's lost confidence in them.
I can't see how they'll recapture that kind of optimism about it. I mean, it is, and it has been for a long time. It really is just a utility stock. It's not it isn't going to grow sufficiently to justify a 40 times PE again. It just isn't. I mean, it has to be 20 times.
I've now got a theory that you've got to watch out for stocks that get above $100, because Kohler has also crashed and it's trading at 96. So Kohler is also down more than 50%. WiseTech got above 100, now down to 38.
What about Macquarie?
Perpetual. There's a couple of exceptions I'll come to. Perpetual, I think, got very close to 100, now down to 16. Magellan was right up there, getting up towards the ton, now down to 865. So there's two standouts, obviously. Macquarie at $241. You'll like this, Alan. I own 3, and I've got a sell order at $250, because you can't own less than $500 worth of shares. So I'm overweight Macquarie with 3. So if they get to 250, I'll be selling 1 and only owning 2. And CBA at 162. But these stocks that go through 100, they're not going to just keep going up forever. And the two big global Cs, CSL and Kohler, have both fallen by more than 50% in the last 12 months, and have had massive profit warnings and like 30-40% crashes in one day. Cochlear's just recently. So no one is above a smashing. And
yep.
But I agree with you. I think CSL's business fundamentally, Kohler, it's a bit of a narrow, it's a medical device company. CSL is a genuine global big pharma company, top 10 pharma company in the world with a diverse range of products, global operations. I think they'll come back, but the market has just lost confidence in their leadership, and they'll need to appoint a new long-term chair and CEO who can rebuild that trust.
And look, I think we've pretty much covered the budget. If anyone has got more questions about the budget or anything else, obviously just send them in, and next week I'll be talking to James Thompson, so he can give his views on the budget at that point and what's been going on. And there'll be more developments, I presume, in the next week or so. Certainly a lot more argument about it. So we'll see what happens. So until next week, thanks everyone for listening to today's episode of Money Café. I'm Alan Kohler, Editor-at-Large of Intelligent Investor and Finance Presenter and columnist for the ABC.
And I'm Stephen Mayne, Contributor to Intelligent Investor, founder of Crikey and shareholder activist. We'll talk to you soon.
Thanks for listening to the Money Café. If you want a little extra to take away with your latte, try Intelligent Investor Essentials. Go to moneycafe.com.au. For just $297, you'll get my weekend briefing at 7 a.m. on Saturday morning, Talking Finance podcast, CEO interviews, plus a Money Café cap, splendid thing it is, and 3 months of premium. That's Intelligent Investor Premium. It's a great deal. It's valued at $727 for just $297. Get in quick at moneycafe.com.au and T's and C's apply.